Major indices were all in the green yesterday, and that was a 5-day winning streak now. Joining us, Duff, Managing Director at GenTrust's, and you're just on the record now, Mimi. Fixed income. Go ahead, go out a little bit longer and feel comfortable and not nervous making that move. So you think rates have peaked and it's clear sailing from here?
Well, it's hard to say if rates have peaked. We definitely have seen some better inflation prints, and I think the market, both on the bond side and the equity side, are taking some relief in that. I think time is going to tell whether we can get all the way down to 2% on inflation, but this rate stability is definitely adding to performance on both the interest rate and the bond side and the equity side as well.
It really has to do with your own situation, because the assets, equities and fixed income, are correlated. So when interest rates are going up, you definitely don't want to be in bonds, and it's probably not a great time to be in stocks. But you know, if interest rates are coming down, yeah, you can feel safe getting, you know, your 5%. You won't lose principal probably, but the stock market will probably do much better. So for someone who's young or who has a little bit more risk tolerance, you would really never be in bonds unless you're an insurance company or a pension plan or something where you had to know exactly what's going to be there in 5 or 10 years. Do you see what I'm saying? I mean, I know that's your business, and there are, in terms of asset allocation, you need to have, you know, part of your portfolio that's more stable. But when things are good, stocks are better, and when things are bad, neither one of them is really a good place to be.
Well, I would chime in a couple things. One, when stocks are bad, you want to have something to sell to buy more stocks and to rebalance, and that's a big part of what we do in sloppier times. You don't want to be so handcuffs that you're afraid, hiding out when those stocks are bad. And then I would also say rates got sufficiently high that if rates were to go further higher from here, you'd earn your way out of it. And I think higher rates from here, if we were to see another retest, I think that weighs on equities. So take your point about the appropriate asset allocation mix for different participants in the market. But we do think that we believe in diversified portfolios.
But Mimi, if you're in 10 or years or longer, and you can't sell those to buy stocks when the market goes down, because you're selling a $1,000 bond for $800. So you're taking a capital loss there as well if you don't hold to maturity.
Well, you certainly can sell them. And the beauty of Treasury bonds, for instance, they settle.
You can sell them, but at a loss. You can sell stock. You can sell stocks at a loss too, but you're selling them at a loss, right? If you bought them, if you bought 10-year Treasuries at 2.5% or 3%, and then you're selling them now 10-year, you're definitely selling them at a loss.
We certainly weren't advocating overweights in bonds when they were at 2 or 2.5%.
Right, but if they go to 7 from here, the 5 is not going to be good. Great.
Fair enough, but we still believe it's less bad from 5% to 7% than it was from 2% to 4%, because bonds at higher yields have less risk, if you will.
Right. It just seems like I don't know, just for a Pfizer or you know, obviously Pfizer's had a big capital loss, but if you bought a Pfizer at $30 with a 5% yield, you've actually got potential dividend increases, you've got capital appreciation. It just depends on, I really think it depends on your time frame and how much stability you need in your portfolio and how much risk you can actually take. So you can see, I guess I'm thinking about Ron Barron was on, he said he never bought a bond his entire life, never bought a bond. And if you think you're any good at all at picking stocks, it just seems like you can always find something in the stock market that over time. But we've been in how long have this bull market's been really since 1980? So we really haven't been in a horrible period where bonds really would probably be better, that nice consistent income. Tax-free bonds might make sense. How about that, maybe? Give me 5%
Listen, we hold a lot
tax-free.
of equities for our clients. I feel like we're getting a little bit too much of a bond house rap here. We hold a lot of equities for our clients, a lot of municipal bonds as well. We believe in large diversified portfolios.
I just hear Mimi Duff, and I'm thinking, oh, she's, that rating agency. That's what I was saying. I think you just you got to be a bond person because your family has that big ratings, but it's not you. That's the only problem.
Relation.
The only problem with that.
That's the only problem with that theory is it's completely inaccurate.